Okay, for today, let's go over a quick question. Why does Exxon pay dividends, but Apple doesn't? Now, Exxon and Apple are just example here, and we will be using these two companies as a starting off point to explain why some companies do pay dividends and others don't. If we take a quick look at their financials, ExxonMobil is a much smaller company with a market cap of about 468 billion dollars, whereas Apple has a market cap of about 2.6 trillion dollars. For price to earning, Apple's price is about 28 times per its earnings, but for Exxon, it's about 8.7. So you would think that because of the highly inflated nature of Apple's pricing, that there's something wrong. But given the nature of the stock market, this is just how the different industries are priced at this point. The dividend yield for Apple right now is about 0.5%, whereas for Exxon, it's about 3%. So why does Exxon pay dividends but Apple doesn't? Well, in order to explore this, let's take a hypothetical example of a small restaurant. Let's get rid of the title here. So imagine for a moment that you are the owner of a small restaurant that you had opened, and for 1 year you generate some revenue. So here is your restaurant. You are the 100% owner of this restaurant, and you generate $1 million in revenue. That same year, you pay about $800,000 in expenses, and that nets you about $200,000 of money that you want to have a decision on what you want to do with. So, as the 100% owner of this restaurant with this $200,000 in your restaurant company, you have a few options here. Number one, you can pocket that money as profit and pay yourself that $200,000, or you can reinvest that $200,000 into your restaurant. Maybe your restaurant is in need of some additional cookware. Maybe it needs to upgrade its stovetops. Maybe you even want to invest in a new storefront and expand your enterprise. However, you decide, the goal for this is basically to maximize the funds you get. Maybe you think that investing in your own company will net you greater and greater revenue in the future years, so you decide to invest. Or maybe the market's not doing so hot, or the restaurant industry isn't doing so well, so you decide you want to pay out those funds as profit. Now, for a corporation, the decision matrix is basically the same thing here. So instead of just you running a small restaurant, let's say you are the CEO of a big size corporation. There we go. And you, as a CEO, are in charge of maximizing shareholder profit. So it's not just you owning it. You have a number of shareholders who are your bosses, and you, as the employee, need to make sure that they get paid the most amount of money possible. So let's say in that 1 year, this corporation earns $10 million. And for its expenses, just keeping the same ratio, let's say you spent $8 million. This is for equipment, for paying salaries, and whatever other expenses there are. And so you're left with $2 million for that year. Again, the decision you have to make as a CEO is, how do you make the most money for your bosses or for the owners? Well, number one, simplest thing is you can just give the money over to your investors as profit. Or you can turn around and put that money back into your company and expand your corporation because you think that that investment will have a positive return in the future and give better bang for your buck than just giving the money out. So then the natural question is, how? How do we decide what to do here? Well, there's a simple thing called the net present value, and that is, you evaluate all of the possible projects that are in front of you, and you see, if you invest that $2 million, does the net present value of those projects exceed, or is it less than that $2 million that you would put in? So let's say you are the CEO of a large restaurant chain corporation, and you believe that, hey, instead of paying this money out to your investors, it would be a better idea to open up new restaurants, and such that the net present value of all of those new restaurant openings will exceed that $2 million. In that case, it might be a good idea to go ahead and invest and expand your enterprise, because in the long run, your investors will make more money. However, if it looks like that the restaurant business will not be doing so hot in the near future or in the far future, such that your net present value calculation says that your earnings will be less than $2 million, it would be a better idea to put money back into the pockets of the investors. So, this in a nutshell is how corporations decide whether to reinvest their assets into growing the company or to paying it out. Very simply put, because Exxon believes for a large portion of their profit, it would be best to pay it out to the investors, they do pay it out. But for Apple, with their low dividend yield, that means that they are confident that reinvesting in their company is the best way forward for their investors. We'll hope this is helpful. And as always, for all your dividend investing needs, check out Div Income, available on Android and iOS.